Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing AT&T stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. AT&T is one of the largest telecom companies in the world. The company began its history as the American District Telegraph Company, formed in St. Louis in 1878. It launched as an independent company in 1983 when U.S. regulators forced the breakup of the Bell system monopoly. So as a result, AT&T spun off its subsidiaries into regional carriers. It paid $102 billion for Time Warner back in 2018. It will sell Time Warner for $43 billion to Discovery. This transaction was set up as a reverse Morris trust, which allows a company to spin off and sell assets while avoiding taxes. The $43 billion will be used to pay down debt, and it will save AT&T $2 to $3 billion per year in interest payments. The new entity will consist of 100% of Discovery plus the Time Warner division. Discovery shareholders will own 29% of the new entity, and AT&T shareholders will own 71% of it. So when the spin-off actually occurs, you will retain your AT&T stock, but also be given stock of the new entity, and that new entity is Discovery plus Time Warner. The company said the main reason for the divestiture is to become a pure-play communications company similar to Verizon and T-Mobile. Also, the margins are higher for its communications business versus its Warner Brothers division. The company is headquartered in Dallas, Texas, and was founded in 1983. The ticker trades on the New York Stock Exchange, Mexican Bolsa, Deutsche Börse, Zicha, Vienna, Swiss, Colombia, EuroTLX, Sao Paulo, Lima, and Buenos Aires Stock Exchange. Let's get started with the model. This is a large cap company, 171 billion market cap. They're trading at $24 a share, and they have 7.1 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. You can see this company generates tons of cash flow. Every year it's over $22 billion. It peaked in 2019 at $29 billion. But even in 2021, it's over $25 billion. Free cash flow is a cash that's remaining for you, the investor. And they pay a really nice dividend. Another way to reward shareholders is to buy back stock. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's the highest ever in 2021 at $21.5 billion. Below that is their revenue, and that peaked in 2019 at $182 billion. It's currently $169 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. If you use AT&T for your phone service, and you're not getting good reception, and you call them to try to get some support, the salary of that support representative is in cost of revenue. Revenue minus cost of revenue gives you your gross profit, and that's pretty consistent year to year. It was highest in 2019 at $97 billion. Below that is their operating expenses. Marketing is a big operating expense for this company. Gross profit minus operating expenses gives you your operating income. So you can see their operating income was almost as high as 2019 with a lot lower revenue. So their margins were a lot higher and they're becoming more efficient. Below that is the interest they pay in their debt, and they have lots of debt. I think more than any company in the world. They paid nearly $7 billion of interest, which was lower than prior years. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. And that's the only reason they had negative net income in 2020, was this big negative in other income and expenses. This is mainly a goodwill impairment from their Vrio divestiture. We'll talk more about that in a little bit. Then you have your pre-tax income, then your taxes. And you can see they paid nearly $1 billion of taxes with negative pre-tax income, because impairments don't help your taxes. Because say you had a business and the business lost money for the year, you wouldn't pay any taxes. You'll probably get a tax refund. So when people see negative pre-tax income, they expect a tax refund. But when the accountants at AT&T calculate their taxes, they have to strip out this $20 billion impairment to do that. And the bottom line of the income statement is their net income, which was highest in 2021. So they had a really good year in 2021, even with lower revenue compared to 2019 and 2020. This is the company's income statement from their latest quarterly report. This shows us 2020 and 2021 and each individual quarter as well. Their revenue in 2021 was $169 billion, and then the cost of revenue, $24 billion for equipment, $25 billion from operations, and $31 billion from other. That gives them a gross profit of $89 billion. When you divide that by their revenue, their gross margin is 53%, which is a little worse than their industry. The median in the industry is 58%, the average is 57%. They spend $38 billion in SG&A, selling, general, and administrative expenses. These are all the expenses not tied to making a product or delivering the service. These are the day-to-day expenses, like the salary for support functions like HR, marketing. And when you see an AT&T commercial, the cost of that commercial goes into SG&A. And they had a big asset impairment in 2020 of $19 billion. I think $12 billion of that was from Vrio, and then the rest were other asset impairments. Their depreciation is really high because they have lots of fixed assets on their balance sheet. $29 billion in 2020, $23 billion in 2021. They have been reducing their debt, so their debt is $8 billion in 2020 down to $6.9 billion in 2021. Their net profit in 2021 was $21.5 billion. So their net profit margins are 13%, net profit over revenue. The median in the industry is 4%. Here's a breakdown of their revenue by quarter. If you use AT&T phone services, then what you pay them goes into their mobility bucket. That was $21 billion. $6 billion from businesses. Some consumers are not wireless. They still use cables to connect to their phone. Warner Media was $10 billion. That's going away. And that was the most revenue they've ever had in a quarter with Warner Media. You can see it was $9.5 billion in the fourth quarter of 2019. Then it dropped dramatically to $7.8 billion, then dropped again to $6.7 billion. But it's been going up since then. Their revenue in Mexico was $704 million. Vrio went down from $756 million to $359 million. That should be zero or close to zero next quarter. The company announced the sale of its Vrio division. That was back in July, but these types of sales can take a few months for everything to complete. The company divested two divisions, US Video and Vrio. Video is fully divested. You can see it's zero in the fourth quarter of 2021. There was some residual revenue in the third quarter of 2021 of $2.1 billion, but now it's totally gone away. They're trying to get away from everything except their core telecommunications business. I think they're keeping Mexico because that is telecommunications, but just in Mexico. You can say what you will about AT&T. I've seen a lot of people bashing the company, saying the management doesn't do a good job, the company's going downhill. But look how many subscribers, 166 million up to over 200 million. And they're adding subscribers every single quarter. They added 5.3 million in the fourth quarter. That's a lot of subscribers. That's a lot of people using your service. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So you could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So after paying all their day-to-day expenses, they still have well over $40 billion of cash remaining. That is a lot of cash to work with. They always spend a lot on CapEx because they're constantly improving and building out new infrastructure. $15 to $20 billion a year in CapEx. Operating cash flow minus CapEx gives you your free cash flow, which is over $20 billion every year. $25 billion in 2021. So that's why they pay a really nice dividend, because they have so much free cash flow. This is their operating cash flows from their statement of cash flows. This is directly from the company's financial reporting. And the way you calculate operating cash flow, you start with your net income or net loss. Then you have to add or subtract the non-cash items. In the fourth quarter of 2020, they reported a net loss of $14 billion, but they passed through $16 billion of asset impairments. Those are non-cash items, so we have to add those back. Remember, operating cash flow is net income, but converted to cash. They always have lots of depreciation to add back, $5.7 billion. And they have to buy a lot of content, film and television content, so that gets amortized. That was $2.6 billion. And we have to adjust for changes in working capital. It looks like they spent $4.5 billion of content, and they used almost $4 billion of accounts payable. When a company uses accounts payable, it's a cash inflow in that accounting period. But when they pay for those products, it'll be a cash outflow in that reporting period. Even though they reported an accounting profit of $5.4 billion, they actually generated over $11 billion of cash flow. My two favorite numbers to look at are revenue and operating cash flow. And you want to make sure if revenue goes up, so does operating cash flow. It's possible operating cash flow could go down for like one reporting period. You just want to understand why. But over time, you'd like to see positive and growing operating cash flow. And they're a pretty stable company. They're not growing like an Apple or Google, but still they have tons of cash flow. This is the company's investing and financing sections on their statement of cash flows. In their investing section, it lists CapEx, capital expenditures, investments in property, plant, and equipment. They spend anywhere from $3 to $5 billion a year in CapEx. And they have a lot going on in their acquisition section. That's also part of investing cash flow. Every year there's acquisitions. This $23 billion was mainly from the acquisition of Spectrum. This article in the beginning of 2021 talks about AT&T borrowing $15 billion from Bank of America. And here's the $15 billion down here in their financing section. So in their investing section, they had a cash outflow of $5 billion in the fourth quarter. In their financing section, they added $5 billion of debt. They repaid $5 billion of debt. They paid another $1.5 billion of debt. And they had an outflow of $3.7 billion of dividend payments. In their financing section, they had a cash outflow of $6.6 billion. Let's look at their capital structure. $166 billion of equity, $200 billion of debt. They're 45% equity, 55% debt. Here's a visual of their debt, equity, and cash since 2015. So their debt and equity is always pretty close year to year. I prefer to invest in companies that have more equity than debt. But the fact that they're bringing in so much cash flow, I would probably be okay in this situation. But if their operating cash flow is 1/3 of what they bring in, I'd probably be a little concerned. They always keep a few $1 billion a year in cash on hand, but each quarter they're bringing in more cash flow than the cash they currently have on their balance sheet. And some people say once interest rates go up, companies like AT&T and Ford and all the companies that have lots of debt are going to be in trouble. I wouldn't say they're going to be in trouble. Small companies will be in trouble. Big companies like this are too big to fail. They'll be able to renegotiate their debt terms because if a company like AT&T defaulted on its debt and couldn't pay its debt holders anymore, then there will be a huge trickle-down effect causing lots of other pain and defaults. This is a visual of their balance sheet. They have a lot of long-term assets, mostly intangibles, which aren't really worth much. Physical assets have value, and of course current assets like cash, receivables, and inventory. But you can see a bulk of its assets all long-term, which is not ideal. But once again, they're bringing in so much cash flow, it kind of trumps these things. And their debt, other liabilities, and accounts payable easily cover their equity, so it's not the best balance sheet. I gave them the highest whack on Finbox, 7.2%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's $286 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $285 billion. We divide that by 7.1 billion shares. And we get a calculated stock price of $40. They're trading at $24, so they're trading at a 40% discount. It's a strong buy according to the model. Their free cash flow projection for this year is $23 billion. $3 billion of that is from Warner Media. So I stripped out that $3 billion and I gave them $20 billion of free cash flow for 2022. And they say their growth is in the low single digits, 3% plus. I gave them an even lower growth of 1%. So I grew their future free cash flows 1% for the next few years. Even with a high whack and a really conservative free cash flow growth, the stock is still undervalued. But the problem is, this stock does not move too much. It's not like a really popular tech stock that can really jump a lot in price. So even though the model says $40 a share, I don't think it's going to hit $40 for a while. The website simply Wall Street values the company at $80, which is just crazy. It's not going to hit $80. They're saying it's 70% undervalued. 13 analysts priced this stock and the average price target is 29, the lowest 20, the highest 41. This is where the stock has been trading the last 2 years. It came down a lot like other stocks in the COVID crash. Its low point was about $27. But then over the next few months, it got up to 33. But when they announced the dividend cut, then there was a big sell-off. I feel the stock should be in the low 30s. I'm not sure if it's going to hit the low 30s, but I think that's where it belongs. So I could see the stock really struggling to break through these price points for a while. But if investors get more confidence in the company, then it could end the year in the low 30s. They raise their dividend every year. It was 49 cents in 2017. It's up to 52 cents. And their dividend yield is over 8.5%, which they could afford. It's 69% of their net income, 58% of their free cash flow. And probably 90% of the people who invest in AT&T do it for that dividend payment. People who are retired and need guaranteed income, they like companies like this. Their last 4 dividend payments equal $2.08. And they said they're going to cut the dividend to $1.11 from $2.08. So the dividend should be almost cut in half in 2022. The yield will be around 4.5%. But if the stock price keeps coming down, then the yield will go up because the yield moves opposite the stock price. So the company is saying their yield will be 6.2% because they're expecting the stock price to come down while they pay this $1.11 dividend, which will bring the yield up to 6.2%. If you own 10 shares of AT&T, after this merger, you will own 10 shares of AT&T and 10 shares of the new entity, the Discovery Time Warner entity. And Discovery does not pay a dividend. They may in the future, but currently they do not. Their dividend yield is at its peak currently. The dividend from 2011 to 2018 was between 5.5% to 6%, so it looks like it's going back to that level. They have a low beta 0.63 because the stock is not volatile, it doesn't move too much. It's gone down 17% in the past 52 weeks while the S&P is up 12%. The 52-week low is 22, the high is 34. And the stock is on a decline, as we all know. It's trading below its 50-day and 200-day moving average. This is a really popular stock. Over 60 million shares are traded each day. Almost all the shares outstanding are on float. 54% are held by institutions, and a little over 1% of the shares are shorted. They were close to 270,000 employees back in 2016, but that's come down to 203,000. Which is not ideal. You don't like to see employee count decreasing. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $14,000 today. That's a 3.5% annual return. In the past year, there's only been insider buying, no selling. Here's the date, the person who bought, the shares, and the price. Half the shares are held by institutions, half by the general public. The biggest shareholder is Vanguard at 8%, 571 million shares valued at $14 billion. Then BlackRock, State Street, Newport, and Geode. Let's look at their financial ratios. Look at that PE, 8.0, unreal. That's stock price over earnings per share. And the way you calculate earnings per share, it's net income over shares outstanding. This means investors are paying $8 for $1 of earnings. The reason it's so good, their PE ratio, is because the stock price came down a lot and their growth is pretty stable at this point. They don't have massive growth. I know there's lots of investors that look for stocks that have a PE below 15. But you have to realize if you invest in a stock with a really low PE, you may not see much growth at all. And right before a company goes bankrupt, they usually have a PE below 1. This would be good to talk about on a live stream. I could explain why. So their revenue is almost equal to their market cap. That's an amazing price to sales ratio. And price to book of 1.0. That's stock price over book value per share. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on a balance sheet. But their tangible equity, when you minus goodwill and other intangible assets, is negative 126 billion. So their tangible book value is negative. They have a decent ROIC of 6.5%. That's operating income times 1 minus tax rate over equity plus net debt. Net debt is debt minus cash. If a company has lots of debt like this company, you want to make sure they have a sufficient interest coverage ratio, at least above 2. And theirs is 4.1, so they can cover their interest payments with their operating income more than 4 times. They have a good ROE at 13%, that's net income over equity. They always seem to have a current ratio and quick ratio below 1. That's current assets over current liabilities, so they can only cover 70% of their current liabilities with their current assets. If they had negative operating cash flow or really low operating cash flow, this will be a big concern, but they don't. They bring in lots of cash. Their free cash flow in 2021 was $25 billion, but they have negative $25 billion of working capital, and they pay out $15 billion of dividend payments, so they're going to be short $15 billion. So it looks like they will need to add some more debt to get through the next 12 months. The best way to look at ratios is to compare them to companies in the same industry. There are 61 companies in the same industry as AT&T. And AT&T is the second largest in terms of market cap. Verizon is the largest. And they spend a ton of money in CapEx. Their debt to equity ratio is actually better than average, because even though they have a lot of debt, they do still have a ton of equity as well. Their dividend is really high, but even after the dividend cut, it's still going to be higher than average. They bring in more free cash flow than any other company in this industry. And they bring in more free cash flow than almost every single company in the world. And look at their price multiples. Look what a great value AT&T stock is. Their PE is 8, the average is 25. Price to free cash flow is 7, average is 16. And their ratios are a lot better than Verizon. They bring in more revenue than Verizon. They're not really growing, same as Verizon. Once you get really big to these levels, it's hard to grow much. T-Mobile's growth is amazing, 23% average in the past 3 years. So to summarize, I have them trading at a 40% discount. For a long-term hold, I think it's a great investment. It's a really solid company. You might see some declines this year and possibly next year until things stabilize. But once that happens, then I think the stock will start going up and the dividend will start going up. There might be some more downside, but I can't see that much more. Maybe another 10 to 15%. But there's pretty limited upside as well. The stock generally doesn't jump too much. But if the dividend gets back up to 7, 8, or even 9%, most investors don't care about the growth of the stock. They're just happy with their dividend payment. I rank their free cash flow 7 out of 10, their revenue 7 out of 10, and their ratio is 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.